Treasury stock is when we buy back stock in our own company. We've previously issued it. We don't cancel it. We can turn around and reissue it later on. It will reduce the number of shares that are outstanding, but not the number of shares that have been issued. Treasury stock has no voting rights. We don't have voting rights. We don't pay dividends. It's not an asset to us. So it becomes part of my capital or equity section. Why do we buy back our own stock? Well, one reason is we think the price is going up. Everyone else buy stock hoping that the price is going to appreciate. We might feel like our company is just undervalued and the market doesn't value us as much as it should. We think the price is going to go up. Maybe we have a stock purchase plan where we want to have stock to give to our employees in. To maintain a positive market, we're going to see when we buy back our own stock, what happens to the number of shares that are outstanding for anybody else to buy? It's going to go down because we bought some of it back, right? But what happens to the quantity, the supply? If the supply goes down, sometimes that can make your price go back up. So the impact of this hopefully is to increase the market price of our stock. To reduce the number of shares outstanding and increase earnings per share. We'll talk about that at the end of this chapter. To avoid a hostile takeover. Maybe you think somebody's trying to take over your company. If you buy back some of that stock, then the person who's trying to take over would not be able to get those shares. Really common. Again, here's one for policy management systems. This is years ago, but notice they bought back 200,000 shares on a Wednesday, hoping to raise its stock price. Because again, we've got supply and demand. If we buy back our own stock, the number of shares outstanding has gone down. Ownership of our company is now divided between a smaller number of shares. Hopefully that'll make the market price then go up. Here's Target. They're buying back $5 billion in shares. A total of $10 billion program plus another 5. So share buybacks allow a company to invest in itself and create added demand for its shares. That gets into supply and demand. When the supply is reduced, that can cause, the demand can drive the price up then. And here's McDonald's. They're doing lots of it, aren't they? Year to date, 2011, $3 billion. Treasury stock is a contra account to my stockholders' equity. That's new to us. Haven't had that before. But we have had contra accounts before, haven't we? Tell me what one is. Accumulated depreciation was a contra asset subtracted from the asset on the balance sheet. Tell me another one we had. Sales R&A and sales discounts, good, were contra accounts to sales. They were subtracted from sales on the income statement. Treasury stock is a contra account to my stockholders' equity. It will be subtracted in the stockholders' equity section of the balance sheet. So whereas my normal capital or equity accounts have a credit balance, treasury stock is going to have a debit balance instead then. When we go to prepare the stockholders' equity section of the balance sheet, the very last item before we get our final total will be the balance in treasury stock, and we will subtract it. We will subtract the balance in treasury stock before we figure total stockholders' equity. Here's an example. Again, you see I have paid in capital and retained earnings, and then at the very next to last step before I figure total stockholders' equity, we will subtract the balance we have in my treasury stock account. So it's going to be the last thing in the stockholders' equity section, and it's going to be subtracted. When we buy back our own stock, we're going to debit a new account called treasury stock for what we pay for it. So if it's $5 a share, I'm going to debit treasury stock, and then I'm going to credit cash because I had to pay cash for it. When I reissue the treasury stock, I might get the same amount that I bought the stock for. Hopefully, I'm going to be able to reissue it for more than what it cost me. But sometimes when I go to reissue it, I'm going to get less than what it cost me. Hopefully, I'm going to get more. Maybe I'll get the same. Sometimes I might get less. We wouldn't like that, but the price that our stock is trading for is a factor that we don't control. Let's suppose we get the same amount for our stock as what we paid for it. We would have more cash to make the asset go up. We would have less treasury stock to make it go down, then we would credit it. A key rule here, when I buy treasury stock, the shares go into the treasury stock account at what I paid for them. Anytime I reissue treasury stock, the shares have got to come out of that account again at what I paid for them. They went in at $5 a share, they got to come out at $5 a share. So keep in mind, whatever amount those shares go into the treasury stock account at, they must also come out of that account at the exact same amount. Hopefully we issue the stock for more than what we paid for it. We're going to debit cash for what we get. We're going to credit treasury stock for what we paid for it. And the extra amount goes to a new account, PIC, but not PIC in excess of par, PIC from treasury stock. PIC paid in capital or equity account is going to have a credit balance in. What if I reissue the stock for less than what I paid for it? I'm going to debit cash for what I get. I'm going to credit Treasury stock for what it cost me, but this time to make it balance, I need something to debit. The first place I go looking for an account to debit will be PIC from Treasury stock. If I have it, if I have a current credit balance in that account, I can debit it for what I need up to the point of zeroing out its balance. I cannot shift that PIC from sale of Treasury stock to having a debit balance. I can zero it out, but that's all. If I need another debit to make it balance, I then debit retained earnings. The only time we'll debit retained earnings is if we have completely wiped out the balance that's in PIC from Treasury stock, and I need more to debit to make it balance. So here's what my entry looks like if I reissue it for less than what I paid for it. Debit cash for what I get, credit Treasury stock for what those shares cost me originally. First place to go looking for a debit PIC from Treasury stock. To the extent that that account has a balance on your books, you can zero it out. If you need another debit, the debit goes to retained earnings. The only time you debit retained earnings is if you need an amount more than what you have in PIC from sale of Treasury stock. Let's do an example. We buy 100 shares, $6 par, common stock for $1,000. In other words, we pay $10 a share. If we buy $1,000 worth, and that's 100 shares, $10 a share. The stock was originally issued for $7 a share. You do not need to know the par value. Put an X through it. You don't need to know it. If you try to use it, it will not work. You do not need to know the par value. You do not need to know the fact that the stock was originally issued for $7 a share. You don't need to know that either. So there is info there that you don't need and you don't want. First off, let's record buying back our own stock. What do I have more of? Treasury stock. Treasury stock is a contra account to Stockholders Equity. I'm going to debit Treasury stock for the number of shares times what I paid for it. All right, I bought back what? 100 shares and I paid $10 a share. What do I have less of when I buy back my own stock? I have more Treasury stock and I have less cash. Here's the key. Those shares went into the Treasury stock account at $10 a share. Anytime I take them out now, they've got to come out of that account at $10 a share. That is the key to getting everything right. They went into the Treasury stock account at $10 a share. When I reissue those shares, they must come out at $10 a share. Now it's time to reissue them. We reissue 10 shares for $10 a share. Are we happy? Are we sad? We paid $10 a share, we're getting $10 a share. Nothing good, nothing bad. What do I have more of? Cash and asset goes up with the debit, good. And what do I have less of? Treasury stock. Now remember, the shares went into Treasury stock at $10 a share. They're coming out now at $10 a share, which is the same as what I got for those shares. Next, we're going to reissue 30 shares for $15 a share. Happy? Sad? Happy. Why? We're getting more for it than what we paid for it. Very good. What do I have more of? Cash. How much cash did I get? $4.50, 30 shares, $15 each. What do I have less of? Treasury stock. Now here's the key. The shares went into the Treasury stock account at how much per share? 10. They must come out now at 10. So my credit to Treasury stock is for how much? 300. 30 shares, $10 a share. Doesn't balance, does it? To make it balance, I need another credit for $150. That credit goes to PIC from sale of Treasury stock. That is not PIC in excess of par. That is PIC from sale of Treasury stock. So what did I do? I debited cash for what I got. I credited Treasury stock for what it cost me. The extra amount goes to PIC from sale of Treasury stock. Let's do another. We got 60 shares left. We reissue those for $7 a share. Happy or sad? Sad. I paid $10 a share. When I reissue it, I only get $7 a share. What do I have more of? Cash. How much cash do I have? $420. Let's debit cash for $420. What do I have less of? Treasury stock. Now those shares went into my Treasury stock account at how much per share? 10. So they must come off my books at how much per share? 10. My credit to Treasury stock has to be for how much? 600. Skip 2 lines. Doesn't balance, does it? We need a debit to make it balance. The first place we go looking is to see if we have any amount right now in PIC from sale of Treasury stock. Do we have any in that account? How much? $150. Now, how much do I need as debits right now to make this balance? I need $180. So do I need all $150 of that amount? I sure do. So we're going to debit PIC from sale of Treasury stock for $150. That's all I can debit it for. I can zero out that account. In other words, wipe out its balance, but I can't switch it over to having a debit balance. Finally, to make it balance, we need how much more? $30. And that goes to retained earnings. for whatever it takes to make it balance here. So if I need more of a debit to make it balance than what I have in PIC from sale of Treasury stock, that goes to retained earnings. What if I had had $200 from the previous entries in my account for PIC from sale of Treasury stock? What would be different about this entry? Wouldn't need retained earnings. Exactly. We could debit PIC from sale of Treasury stock for the full 180. What if the third entry, to reissue the 30 shares for $15, hadn't occurred? That's the entry where we credited PIC from sale of Treasury stock for how much? The third entry? For 150, right? What if that entry had not taken place? Forget that entry and go straight to the one that follows it. What would be different about that fourth entry then? It would all have to go to retained earnings. If I did not have, and this is in your handout, if I did not have any balance in PIC from sale of Treasury stock, the full amount would have to go to retained earnings. Another example, we buy 100 shares, $1 par, common stock for $2,000, in other words, $20 a share. Stock was originally issued for $14 a share. Tell me something there I don't need. The par, don't need that. Tell me something else I don't need. $14 a share. On the test, I'm going to tell you what the par value is. You don't need it. I'm telling you right now, it's not a trick. If I tell you in advance, I'm going to do it. Okay? You don't need the par value. You don't need what you get on the date it's issued. Make the journal entry to record buying back my own stock. What do I have more of? Treasury stock. We debit Treasury stock to make it go up. What do I have less of? Cash. Dan reissues 40 shares of Treasury stock for $15 a share. How much PIC from sale of Treasury stock do we have right now? 0. Happy or sad? Sad. Why? We paid 20. When we reissue it, we only got 15. What do I have more of? More cash. How much cash do I have? 600. No cash. 600. Make it go up. What do I have less of? Treasury stock. Let's skip a line, if you would. Skip a line. How much do we need to make Treasury stock go down by? 800. Those shares went into that account at $20 a share. They've got to come out at $20 a share. Doesn't balance, does it? To make it balance, I need another debit. Where does it go? Retained earnings. Good. Why can't it go to PIC from sale of Treasury stock? We don't have any. We don't have any. If we had a credit balance in that account, we could zero it out. We don't have anything in that account. It has to go to retained earnings. So if there is nothing in PIC from sale of Treasury stock, full amount comes out of retained earnings. Now, we issued 10 of the shares for $28 a share. Happy or sad? Happy. We paid $20 a share. What do I have more of? Cash and asset goes up with the debit. $280 cash, 10 shares, $28 a share. What do I have less of? Treasury stock. Those shares went on my books for how much per share? 20. So when I take them off, I've got to take them off for 20. My credit to Treasury stock then is for 200. Very good. I got more for it than what it cost me. The extra credit goes where? PIC from sale of Treasury stock. Not PIC in excess of par. PIC from sale of Treasury stock. Dan reissues 50 shares, $18 a share. Happy or sad? Sad. I'm getting a little bit less for it than what I paid for it. How much right now do we have in the account PIC from sale of Treasury stock? $80. So the very maximum amount I can debit PIC from sale of Treasury stock for is $80. No more, up to $80. So let's issue 50 shares, $18 a share. What do I have more of? Cash. How much cash do I have? 9. 18 times 50. So what is an account I need to make go down at this point? Okay, Treasury stock. The shares went into the Treasury stock account at how much per share? They went in there at 20, so we got to take them out at 20. 50 times 20 says I'm going to credit Treasury stock for 1,000. We're going to skip a line there. To make it balance, I need a debit for 100. Where's the first place I go looking for an account to debit? PIC from Treasury stock. Did I have any of that? $80. I can debit that account for $80. Nothing more, but I can debit it for $80. Doesn't balance. To make it balance, I need another debit for $20. That debit goes to where? Retained earnings. Whatever I need to make it balance, once I have wiped out what's in PIC from sale of Treasury stock, goes to retained earnings.